You deposit your paycheck on Friday. By Monday, the bank has already made money from it. Not by charging you a fee, not by investing in some genius stock pick, not by doing anything dramatic at all. They made money simply because your money sat still for 48 hours. And the strange part is, most people never notice. Because modern banking is built on one very important illusion, that your money is always there. It isn't. Not really. The number on your screen is real, but the money itself, that's already somewhere else, being used, sold, lent, repackaged, and multiplied. All while your banking app calmly tells you available balance, $2,416.83, which sounds comforting until you realize the bank may have turned that same $2,416 into $20,000 of business. Quietly, legally, and mostly with your permission. The modern bank is one of the most profitable business models ever created, because unlike almost every other company on earth, banks sell something they never actually had to earn in the first place: money. And once you see how the machine works, you start noticing something uncomfortable. The bank is not really protecting your wealth. Your wealth is protecting the bank. For most of history, banks were simple. You gave them gold, they stored it, they charged you for protection. That was the deal. But eventually, bankers noticed something interesting. Almost nobody came to withdraw all their money at the same time. Most people deposited money, then left it sitting there, which created a temptation so powerful it reshaped the entire global economy. What if the bank loaned out some of that idle money? Just temporarily. Just enough to make extra profit. And at first, that sounds reasonable. If 10 people deposit $100 each, the bank holds $1,000. Maybe it lends out $200, keeps $800 safely stored. Everyone's happy. Except banks slowly realized something even more important. People don't usually withdraw cash anymore. Money mostly moves digitally, which means the bank doesn't actually need all the physical money sitting there. It only needs enough liquidity to survive normal behavior. And that's where the modern system begins. Fractional reserve banking. A phrase so boring, it almost sounds designed to prevent further questions. Here's what it really means. Banks keep only a fraction of deposits available, while lending out the rest. So when you deposit money, the bank treats it less like your property and more like wall material, fuel for loans, mortgages, credit cards, car financing, corporate debt, student loans. Your savings account quietly becomes someone else's financial future. And the absurd part? Both of you think the money belongs to you at the same time. You believe your $1,000 is safely in your account. Meanwhile, someone else just bought furniture using that exact same $1,000 as a loan. Financially speaking, the system cloned the money. Now, multiply this by trillions. Because banks don't really move money. They create purchasing power. And this is where the story gets strange. Imagine you deposit $10,000. The bank lends $9,000 to someone buying a car. That dealership deposits the $9,000 into another bank. That bank lends out maybe $8,000. Then that money gets redeposited again, and again, and again. One original deposit can ripple through the system, creating far more money than physically existed at the start. It sounds fake, because it almost is. Modern money is largely built on confidence. Confidence that depositors won't panic. Confidence that loans will be repaid. Confidence that tomorrow behaves roughly like today. And when confidence breaks, things get ugly very fast. Because banks are extremely profitable during calm periods, but deeply fragile during fear.
That's why bank runs are so dangerous. Not because banks suddenly become corrupt overnight, but because the math finally becomes visible. If everyone asked for their money back simultaneously, most banks couldn't do it. Not even close. Which sounds insane until you realize the system was never designed for
everyone to withdraw at once. It was designed around trust, and banks monetize that trust relentlessly. Now, obviously, loans are only one part of the machine. The real genius of banking is that profits come from dozens of invisible directions at the same time. Interest spreads, transaction fees, overdraft fees, late fees, foreign exchange spreads, interchange fees every time you swipe a card. Sometimes the bank earns money even when you avoid debt entirely. Take debit card transactions. You buy coffee, tap your card, done in 2 seconds. Feels free. But behind the scenes, merchants pay processing fees on almost every transaction. Tiny percentages, fractions of fractions. Individually, harmless. At scale, massive. A bank processing millions of transactions daily can generate extraordinary revenue from behavior customers barely notice. Then there's credit cards. Probably one of the greatest financial products ever invented. Not for consumers, for banks. Because credit cards transformed impatience into an asset class. Every delayed payment becomes revenue. Every carried balance becomes recurring profit. And banks became extremely sophisticated at engineering this behavior. Rewards programs, cashback, travel points, limited offers. The system makes spending feel intelligent, like you're beating the game. Meanwhile, average credit card interest rates quietly climb past 20%, which creates a strange modern ritual.